In a remarkable turn of events, Bitcoin has surged back above the $100,000 mark, marking a significant milestone in its journey and coinciding with a wave of new cryptocurrency exchange-traded funds ETFs hitting the market. This resurgence has caught the attention of investors and financial experts alike, with notable figures like Ric Edelman weighing in on the implications of this crypto ETF boom. Edelman, a renowned financial planner and founder of the Digital Assets Council of Financial Professionals, has expressed optimism about the potential benefits these new ETFs offer to investors. In an interview with CNBC's ETF Edge, he highlighted the innovation of buffer and yield ETFs, which allow investors to mitigate downside risks while still capitalizing on potential upside profits. You can now invest in Bitcoin ETFs that protect you against the downside volatility while preserving your ability to enjoy the upside profits, Edelman stated, emphasizing the substantial yields these products can generate compared to traditional stock market investments. The timing of Bitcoin's rally could not be more poignant. The cryptocurrency crossed the $100,000 threshold for the first time since February, bolstered by a nearly 10% increase this month alone. This resurgence comes amid a growing acceptance of cryptocurrencies and a more favorable regulatory environment, particularly in the United States, where ETF approvals are gaining traction. However, Edelman also cautioned investors about the dangers associated with leveraged and inverse Bitcoin ETFs. He pointed out that these products often function under specific assumptions that may not align with typical investment strategies. These leveraged ETFs often have an assumption you're going to hold the fund for a single day, a daily reset, he warned, likening them to buying a lottery ticket rather than a sound investment. Such warnings are particularly relevant as products like the 2x Bitcoin strategy ETF BITs have gained attention for their short-term performance but have underperformed in the long run compared to Bitcoin itself. The conversation surrounding Bitcoin and ETFs is part of a broader narrative influencing the cryptocurrency market. Not only are investors exploring new avenues for engagement, but regulatory bodies are also actively discussing the framework needed to support this evolving landscape. In a related development, BlackRock has reportedly engaged with the SEC to push for a comprehensive overhaul of crypto regulations, indicating a shift towards a more structured approach to cryptocurrency investments. The momentum is not limited to Bitcoin alone. Other cryptocurrencies are also experiencing significant gains, reflecting a growing interest in the digital asset space. As of now, Bitcoin is trading at approximately $104,730, while Ethereum has seen a rise of over 10%. This surge underscores the increasing acceptance of cryptocurrencies as a viable investment option. Another noteworthy development in the crypto space is the recent launch of Re.Pay in South Korea, which introduces a Visa-compatible crypto debit card allowing users to transact using major cryptocurrencies and stablecoins. This initiative simplifies the process of crypto payments in retail settings, potentially paving the way for broader adoption of digital currencies in everyday transactions. As the cryptocurrency market continues to evolve, the interplay between regulatory frameworks, innovative financial products, and investor education will be crucial in shaping its future. With experts like Edelman advocating for responsible investment practices and companies like BlackRock seeking regulatory clarity, the coming months will likely see further advancements that could redefine how cryptocurrencies are integrated into the global financial system. As the industry matures, it remains to be seen how these developments will influence both market dynamics and investor behavior in the long term. In a decisive move that reflects a growing skepticism toward cryptocurrencies among state lawmakers, Florida's legislative body recently rejected a proposal that would have allowed the state to invest a portion of its pension funds in Bitcoin. This decision comes on the heels of former President Donald Trump's push for a strategic Bitcoin reserve, which he characterized as a necessary step for the U.S. to capitalize on the potential of digital assets. In March, Trump issued an executive order that described Bitcoin as digital gold and stressed the importance of managing the nation's holdings in cryptocurrency to maximize their value. Just as it is in our country's interest to thoughtfully manage national ownership and control of any other resource our nation must harness, not limit. The power of digital assets for our prosperity, the order stated. Despite these lofty claims, Florida lawmakers led by Representative Webster Barnaby Ardiland were not swayed. Barnaby's proposed legislation would have permitted the state to allocate up to 10% of its retirement trust fund and other state funds into Bitcoin. During discussions, he urged lawmakers to embrace this opportunity, referencing the potential for great financial rewards. It is a new day. This is a new rising, Barnaby declared, urging his colleagues to place their trust in Trump's vision for the cryptocurrency landscape. However, skepticism was palpable among both Democratic and Republican lawmakers who raised concerns about the inherent risks of investing in such a volatile and largely unregulated asset. Representative Kevin Steele R. Hudson expressed alarm over the potential for catastrophic losses should Bitcoin's value plummet due to a hack or market crash. The second one of these blockchain technologies gets hacked, the value of that coin goes to zero pretty quick, he cautioned, highlighting the intangible nature of cryptocurrencies as a core issue. Similarly, Representative Mike Caruso R. West Palm Beach questioned the wisdom of concentrating such a significant portion of state funds in a single unpredictable asset. Do you think it's wise to invest up to 10% of our entire portfolio in any one item, whether it's Bitcoin or Tesla stock? He asked. The hesitance to invest in Bitcoin was not unique to Florida. Similar legislative attempts across states including Wyoming, North Dakota, and Arizona also failed to gain traction. Arizona's Democratic Governor Katie Hobbs recently vetoed a Bitcoin bill, emphasizing the need for sound and informed investments in retirement funds. Arizona's retirement funds are not the place for the state to try untested investments like virtual currency, she stated in her veto letter, echoing sentiments shared by many in the Florida legislature. This collective pushback against cryptocurrency investments underscores a broader caution amid fluctuating market conditions. Florida lawmakers ultimately decided against aligning with Trump's vision, recognizing the potential risks involved. As the cryptocurrency market continues to evolve, the rejection of such proposals may signal a more cautious approach among state governments regarding the integration of digital assets into public finance. Looking ahead, the debate around cryptocurrencies like Bitcoin is unlikely to diminish. As institutional interest grows, with entities such as Goldman Sachs recently increasing their Bitcoin stake, it remains to be seen how regulatory frameworks will adapt to these changes. The appetite for Bitcoin among investors is strong. Yet the path to acceptance and integration into traditional financial systems is fraught with challenges. The future of Bitcoin investment, particularly in public sectors, will hinge on evolving perceptions of risk, regulatory clarity, and the ongoing dialogue between innovation and caution in the financial landscape. In a rapidly evolving landscape of cryptocurrencies, President Donald Trump finds himself at a precarious intersection of personal profit and legislative progress. Recent events have illuminated how Trump's financial entanglements with digital assets may be jeopardizing crucial legislation aimed at regulating the burgeoning crypto market. As lawmakers express increasing concern over potential conflicts of interest, the fate of key bills hangs in the balance, leaving the future of America's crypto agenda uncertain. This week, the Senate rejected the Genius Act, a bill designed to establish federal guidelines for stablecoins, largely due to apprehensions surrounding Trump's personal cryptocurrency ventures. Senator Jeff Merkley of Oregon highlighted the gravity of the situation, stating, "Currently, people who wish to cultivate influence with the president can enrich him personally by buying cryptocurrency he owns or controls. This is a profoundly corrupt scheme. It endangers our national security and erodes public trust in government." The Genius Act, which needed 60 votes to advance, fell short at 48 to 49, with 3 senators not voting. The backdrop of this legislative failure includes the recent launch of Trump's own meme coin, which has reportedly added billions to his financial portfolio. The coin's value surged after a promotional campaign that offered dinner and VIP tours of the White House to top holders, prompting critics like Senator Richard Blumenthal to label it a pay-for-play scheme. First Lady Melania Trump is also involved, as she has her own coin associated with the venture. Amidst these developments, Senate Democrats introduced the End Crypto Corruption Act, aiming to prevent elected officials and senior executive branch members from endorsing or issuing digital assets. However, the Genius Act's downfall was compounded by a notable shift among Senate Democrats, with 9 members, including some who had previously supported the bill, citing the need for stronger measures on anti-money laundering and national security. Senator Lisa Blunt Rochester of Delaware articulated her concerns over Trump's financial dealings, emphasizing the need for integrity in governance. She stated, "I also remain concerned about the ongoing self-dealing and financial conflicts of interest being carried out by the Trump family. The implications of Trump's involvement in the crypto space extend beyond mere legislation. They threaten the reputation of the U.S. crypto industry on a global scale." Industry advocates have expressed disappointment at the current state of affairs. Ryan Gilbert, founder of fintech venture fund Launchpad Capital, lamented, "It's unfortunate that personal business is getting in the way of good policy," suggesting that Trump's conflicts could hinder important advancements in the sector. He warned that the absence of a regulatory framework such as the Genius Act could jeopardize future investments and innovations within the United States. The White House, while facing scrutiny, maintains that Trump is adhering to all conflict of interest laws. Press Secretary Caroline Leavitt defended the president's business acumen, asserting that it is part of his appeal to voters. However, as lawmakers push back against Trump's crypto ventures, the landscape is becoming increasingly fraught with tension. This political maneuvering extends beyond Washington. In Florida, for instance, lawmakers recently rejected a proposal to invest state funds in Bitcoin, a move that reflected hesitance about aligning with Trump's initiatives as he promotes cryptocurrencies like digital gold. Representative Kevin Steele R. Hudson raised valid concerns about the volatility of such investments, while others questioned the wisdom of tying state funds to a single and proven asset class. As the debate continues, the ramifications of Trump's personal financial interests on national policy remain a critical point of contention. With the crypto industry poised for growth, the path forward will require navigating a complex web of interests and ethical considerations. The ultimate question remains: can the U.S. establish a robust regulatory framework that fosters innovation while ensuring transparency and accountability? The coming months will likely reveal the answer as lawmakers grapple with the challenges presented by both cryptocurrencies and the conflicts of interest that surround them. In a remarkable surge, Ethereum ETH has captured the attention of investors and analysts alike, marking its best weekly performance since May 2021. As of May 10, 2025, ETH has climbed more than 37.5% within a week, including a significant 10.3% increase in just 24 hours. This upward momentum is attributed to a combination of strategic upgrades, favorable market conditions, and significant trades that suggest a bullish outlook for the cryptocurrency. The recent rise in Ethereum's price has been significantly influenced by the Pectra upgrade, which was implemented on May 7. This upgrade introduced several enhancements, including higher staking limits and account abstraction through EIP 7702, aimed at improving the usability of the Ethereum blockchain. With these developments, Ethereum has outperformed the broader cryptocurrency market, which has only seen a total capitalization increase of 10.91% in the same period. Notably, Bitcoin, despite its own rise past the $100,000 mark, has trailed behind Ethereum in percentage gains. Adding to the positive sentiment surrounding Ethereum are recent updates in international trade. The announcement of a new trade agreement between the United States and the United Kingdom, along with the initiation of trade talks between the US and China, has fostered an optimistic environment in the crypto market. The implications of these developments have bolstered investor confidence, pushing Ethereum's price higher. Further fueling Ethereum's rally is a short squeeze in the futures market. Since May 8, short sellers have faced significant liquidations totaling approximately $437.94 million. As prices increased, these traders were compelled to buy back ETH to cover their losses, which in turn drove the price even higher. The total open interest in Ethereum futures has also surged from $21.28 billion to $26.77 billion, indicating strong market participation and a bullish bias among traders. In addition, large investors, often referred to as mega whales, have been accumulating significant amounts of ETH. According to data from Glassnode, these wallets, which hold over 10,000 ETH, have increased their holdings to over 40.75 million ETH, the highest level since March 2025. This accumulation suggests that substantial investors are positioning themselves for continued price appreciation, enhancing overall market confidence. Technical analysis also supports the bullish outlook for Ethereum. The price has recently bounced off a critical support level, forming the lower boundary of a symmetrical triangle pattern. Analysts predict that this could lead to a move toward the upper trendline near $3,400, representing a potential 40% rally from current price levels. Historical patterns indicate that ETH tends to rally after touching this support, reinforcing the optimistic predictions from analysts like Peter Brandt, who anticipates a significant price surge. However, Ethereum is not without its challenges. Vitalik Buterin, Ethereum's co-founder, has called for a cultural shift within the Ethereum community to simplify the blockchain and make it more accessible to developers. He emphasizes the need to reduce technical complexities that have made it difficult for new developers to contribute to the platform. This initiative aims to foster greater adoption and competition with Bitcoin, particularly as the ETH/BTC trading ratio recently hit a low not seen in over 5 years. In the context of institutional investment, BlackRock has made headlines by acquiring over $20 million worth of ETH, adding to its previous investments. This move underscores a growing confidence among institutional players in Ethereum's future, further driving bullish sentiment in the market. As Ethereum continues to evolve and adapt to the changing landscape of cryptocurrency, the combination of strategic upgrades, increased institutional investment, and significant whale accumulation paints a positive picture for its future. Investors are keenly watching for developments that may strengthen Ethereum's position in the market, particularly as it strives to reclaim its status as a leading player in the crypto space. The coming weeks will be crucial for Ethereum as it seeks to build on this momentum and navigate the complexities of the broader financial environment. As the cryptocurrency landscape continues to evolve at a rapid pace, investors are keenly searching for opportunities that promise substantial returns. With Bitcoin recently breaching the $104,000 mark and Ethereum showing a significant upswing, the market sentiment leans towards a bullish atmosphere, sparking interest in various altcoins. Notably, two tokens, Cardano ADA and Mutuum Finance MUTM, are emerging as potential candidates for those looking to amplify their portfolios and possibly achieve returns tenfold by 2025. Despite a recent 2% dip in the overall market, Cardano remains resilient, holding steady at $0.649. Analysts are optimistic, projecting that ADA could reach $1.40 by the end of the year, with long-term forecasts suggesting a rise to over $10 by 2030. This optimism is bolstered by Cardano's increasing adoption, including its recent partnership with Kraken, which allows users to convert their crypto holdings into fiat currency at numerous MasterCard merchant locations. This real-world application not only enhances regulatory clarity but also attracts institutional investors, positioning Cardano as a stable choice amidst market volatility. On the other hand, Mutuum Finance is making waves in the decentralized finance DeFi sector with its innovative two-layer lending system. Currently in its fourth pre-sale phase, Mutuum Finance has raised an impressive $7.9 million from nearly 9,700 token holders. The MUTM token, priced at $0.025, is projected to list at 6 cents, offering the potential for a 140% profit upon launch. What sets Mutuum apart is its unique buy and distribute model, which channels revenue from the platform back into purchasing MUTM tokens, thereby maintaining consistent demand regardless of market sentiment, a stark contrast to the often unpredictable nature of Solana's network. The pre-sale success of Mutuum Finance speaks volumes about its potential. With a current fill rate of 65% and projections for a 20% price increase in the near future. Now is seen as a critical time for investors to capitalize on this opportunity. The project has also introduced a gamified loyalty scheme that rewards long-term holders with bonus tokens, further enhancing investor engagement. While Solana, currently trading around $144.35, has faced its share of challenges including volatility and regulatory scrutiny, its recent price movements indicate a bullish trajectory. Analysts are speculating that Solana could move towards $200, driven by whale accumulation and a resurgence in derivatives trading. However, the allure of Cardano and Mutuum Finance, with their more predictable growth patterns and practical applications, presents an attractive alternative for investors seeking stability and substantial returns. In conclusion, as the cryptocurrency market gears up for what many anticipate to be a significant bull run, Cardano and Mutuum Finance stand out as promising investment avenues. Their unique propositions, Cardano's real-world applicability and Mutuum's DeFi innovations, offer investors a chance to diversify their portfolios beyond the more volatile Solana. With projections of tenfold returns in the coming years, these tokens may very well be the key to unlocking substantial financial growth in 2025 and beyond. As the market continues to evolve, keeping an eye on these developments will be crucial for savvy investors looking to maximize their opportunities in the ever-changing crypto landscape.